Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
It's one of the most difficult calls in my career, but I think the chances are better than 50-50 that he will not be on the ticket, that Kamala Harris at some point in the fall will wind up on the ticket.
The Fed is likely to cut rates in September. We see an economy that is cooling. We wouldn't call it weak, but it is cooling. And we're seeing those inflationary trends also cool somewhat. So we think it's going to be time for the Fed to start moving. And we expect 1 to 2 Fed cuts this year.
It's a good sign from the aspect that they're starting to clear some of these problems, some of these legal overhangs, and that's going to help them focus on the most important thing to do with the company, which is to build more airplanes, generate more cash flow, and generate profits.
We've got 1 hour to go until the market close, so let's take a look at the major averages right now. We have some sideways movement today, a little bit of treading water because there are more events to focus on later in the week. Namely, the Federal Reserve Chair Jay Powell will be testifying before Congress on Tuesday and Wednesday. We've got the Consumer Price Index coming up on Thursday, and then bank earnings begin on Friday. So investors kind of looking ahead, and as they do, not seeing a lot of activity today. We see the Dow off by about 38 points or so, about 0.1%. The S&P 500 very slightly higher. It's been bouncing around a little bit today. Important note on both the S&P and the Nasdaq. If either one of them or both of them closes higher, that will mean a new record for both averages. In the case of the S&P, it'll be the 35th straight record that we have seen thus far this year. You see the Nasdaq up about 0.2%, so it's a little bit more solidly in the green. And as we look at the Nasdaq, it helps to look at the Nasdaq 100 as well, because guess what? The market concentration debate, discussion is still very much alive and well. As we look at the mega caps to see what they're doing today, it's really a mixed picture as well. Meta is off by 2%, but Nvidia on the flip side is up by 2%. We had a couple of price target increases on Nvidia that we are going to get into a little bit later. And then the other sort of muddling along here. If you look at the sector action here for the major average, or for the S&P 500, I should say, communication services in the red, dragged by Meta there, but we've got energy also lower. And then on the plus side, we've got tech. So a split between tech, which includes software and hardware, and communication services, which includes things like Meta. Real estate also showing a little bit of strength today. Josh?
All right, Julie. Investors looking ahead to several key events this week. A semi-annual testimony from Fed Chair Powell, followed by key inflation readings to provide key signals for the path of interest rates ahead. On the corporate side, big banks, JP Morgan, Citi, and Wells Fargo to kick off the second quarter earnings season on Friday. For more on the market expectations ahead, we have BD8 Capital Partners CEO and Chief Investment Officer Barbara Duran joining us here now. Barbara, good to see you.
Yeah, nice to see you both.
So, Barbara, there was an interesting note from Ed Yardeni this morning, Ed being economist and strategist, and he was telling his clients, he was kind of trying to make sense of this market. And Dr. Ed said, it feels like, he said, kind of a slow motion melt up. And he said investors seem like they look at this weaker than expected economic data we get, and they seem to kind of think, that's okay. That just increases the odds that Jay Powell's going to cut. Is that kind of how you're seeing things?
Yes.
Yeah.
It is, and I think that's why the market's been making new highs. There's two things that have been going on, and at different points, they're in a different ascendancy. Like the beginning of the year, the Fed already started last year to discount the prospect of Fed rate cuts. Now, when we came into this year, people thought 6, 7 rate cuts. Well, that hasn't happened. It's been pushed out. Now, lately, been coming back in. But what happened in the meantime? Earnings. Last third quarter last year was when they troughed, and they're just going up and up since then. And this quarter is expected to be no exception. It could be anywhere from 8.5%, 9% or more. And that's what the investors are focusing on, are earnings. And so whether the Fed cuts in September, which I think is increasingly likely given the economic data we've had, but I think that's really what's going on. It's really about earnings now. and the fact that inflation is steadily coming down. And I think investors really believe the next few inflation prints, which you mentioned, CPI and PPI this week, should be positive, but we'll see.
Let's talk a little bit about earnings then, right? Because the market's always an expectations game. And the past few quarters, expectations for earnings have been pretty low. And then companies have beat them. I mean, companies usually beat expectations, but they've now been creeping up. And in fact, if you look at the S&P 500, which I just pointed out is at a record again, but profit expectations have been going up as well. So are stocks sort of in a more delicate position now, so to speak, because of that?
Well, it's a good question, because I think anytime you've had a big run up and you're making, as you said today, could be the 35th high in the S&P, not to mention the Nasdaq and Composite and the Nasdaq 100. You've got, at some point, there's going to be a pullback. We know that. And what we've seen so far year to date, though, it's been shallow. And I think that's what's going to happen here, because the underlying fundamentals are positive. The economy is slowing down. People are glad to see that. It means the Fed, is restrictive, and they will admit that, and that's working. But now we're getting to the point where we're more concerned that we could, start to slow it down too much. And the Fed is cognizant. They keep saying things are in better balance. That means balance between the one mandate to keep jobs and full employment and the other to get inflation down. And we've seen right now that this soft landing or no landing scenario is very much intact. So I think we're in good shape, but it's a question of, where from here. That's always been the question. All the big tech names, they've been, the majority of the gains so far. And I think it's been difficult to see the market broadening out, like say into cyclicals or small cap. A lot of talk about that, how that has lagged, but without knowing the timing of the rate cuts. You can't say this is now, we're ready for the next economic cycle. So I think we're actually pretty close to be pretty certain the Fed is going to cut rates. Then we'll see a broader rotation into that. But for now, even though names like, Meta, Apple, all the great names are above their, historical PE, there's good reason for that. But
how about, Barbara, after the run we've had, when clients ask you how valuation looks for the market, do you say it looks reasonable? Do you say we're stretched, lofty? How are you describing it?
Yeah, it's also a good question. And, one, it's always in the context of interest rates. As the interest rates come down, PEs will expand. And I think we've been seeing that, not as much as we did last year when things like the tech names were really, really sunk. But I think you got this bifurcation, we've all talked about a lot in terms of the S&P, weighted S&P versus the equal weighted. And a large part of the S&P is actually, maybe a 17, 18 PE right now, not that expensive historically. So if the market starts to broaden out, you'll see, perhaps other leadership coming up when the tech names, which I would not sell. So these are great names with great long runways of growth ahead, particularly with the AI. You may take a pause there and see other names, come into the ascendancy and new capital being put into work in that. But
I was going to say new capital. Speaking of which, you called a list of names, the down and dirty brand names might have turnaround prospects. And these, I mean, speaking of down and dirty, some of these are pretty beaten down. Nike, which is at its lowest since 2020, Starbucks, McDonald's, Lululemon, Boeing is on your list also. I mean, does that mean those are names that you're that you are getting into or considering getting into? And what's your trigger?
Well, two of the names I have to admit I own, and have owned for a while, Lululemon and Starbucks. And there's names like Lululemon, Starbucks, McDonald's, Nike. These are all great names that in the past they have a brand and a reputation and a great management approach, and they have all in the past missed at different times. Lulu not until recently, but they've always managed, whether it was an execution issue or a macro issue or competitive inroads. I mean, Nike's gone through this over the many years. They somehow managed to right the ship. And that's why I'm looking at them to see where's, what's the risk reward here, because a lot of these names are discounting the worst possible case. Lulu, I still don't know yet because that could be real competitive inroads. But it could also be they just really missed the product cycle, unusually for them in terms of not having enough color, et cetera, in small sizes. So I'm looking at them because potentially if these managements are able to turn things around and they have announced whether it's McDonald's value, menu, Nike really trying to get back on the innovation track, all that stuff, if it's fully discounted, then there's potentially decent upside, 25, 30% from here. So I'm not doing anything. I'm still looking at them. Boeing is an obvious one. I mean, how long does that take? It's just every month some sort of bad news, whether something flies off, the bolts aren't there. But it is part of an oligopoly. And so at some point, and they've got 7-8 years of backlog. So that's when you have to keep an eye on as to when, and when to get into a stock like that.
Barbara, election years introduce uncertainty. I think this year we can agree more than most. I mean, serious questions about who's even on the ticket right now.
Yeah.
What are you telling your clients, Barbara?
Well, I do get that question from clients, and what I say is basically, Trump is more pro-business than Biden, but Biden is also, pro-business. And we know if Biden remains on the ticket, we do know who Biden is. We know what to expect. I mean, there's not going to be no surprises. And in fact, here we are almost, how many highs in the market and what's happening with unemployment. We've got a pretty good economy, under the Biden administration. And it looks like, there's nothing that's going to derail that, in terms of his plans and what he says. Trump, on the other hand, it's more, for Trump, there's two questions. One is the macro, what happens if he implements the things that he says are his priorities. And there's three things that stand out to me. One is the 10%, he's saying across the board, 10% import tax increase, and China much more. Okay, what does that do? That raises prices. And who does it raise the prices that hurts the most? That's the lower income consumer, who we are already seeing through many company reports, retail, et cetera, that's who is hurting it the most, because they're spending on necessities. Then you have the immigration issue. If he really gets elected and deports millions of immigrants, those are the ones who have been providing, have been taking the jobs that have been open. And that also helps, keep wage pressures down. And then he's also talking about about keeping the tax cuts in place, and that's for the wealthy. Well, we've already seen in that administration, it really the deficits and loss of income for that were not made up in other ways. So to me, what you're seeing is that it probably means higher rates for longer, that's inflationary. And so, what happens then, I don't think it has immediate impact on the market. It's more what we're going to see is sector rotation, which everybody's trying to game that out. And we know one that, Trump will not be pro-regulation. We've already, heard reports of him talking with oil executives. If you support me, I will, give you certain benefits. Clean energy will be hurt. No subsidies, anything that supports them. Healthcare is interesting because healthcare would be bifurcated. Those with Medicare Advantage, like United Healthcare or Humana or CVS, would do well, right? Those who have more of an Obamacare or Medicaid orientation, like a Centene, they're not probably going to get much support, from the government. Tech, both parties seem not to like, right. So they'll, in either case, they'll be after them. And of course, banks, anything that requires regulation. But banks, there's not, I think, big changes that would happen, just less maybe attention to enforcing certain regulations.
All right, that's interesting how you're thinking about all of this. Yeah. Well, Barbara, thank you very much. You're going to stick around, though, and join us in a little bit for Goodbye or Goodbye, so just don't go anywhere. And we're just getting started here on Market Domination. Coming up, Boeing has agreed to plead guilty to a criminal fraud charge surrounding two fatal 737 MAX crashes from 2018 and 2019. We'll check in on the stock later in the hour. Plus, at 3:30, it is indeed the latest edition of our series, Goodbye or Goodbye. You know already who's going to join us. It's going to be Barbara Duran. We'll break down two stocks to help you decide what to do with your portfolio.
And at 4:30, it's Asking for a Trend. I'll be diving into the latest stories impacting your wallet, including the recent moves in crypto. Stick around. All that and more when Market Domination returns.
Let's check in on some trending tickers here on Yahoo Finance. First up, we got Boeing, which is a little changed right now, but if you look at the intraday chart, it's really been bouncing around today. The company agreeing to plead guilty to criminal fraud charges in connection with 2 fatal crashes of its 737 MAX jet. Prosecutors accused the aerospace giant of deceiving regulators who approved the plane and pilot training requirements for it. It's still unclear if this settlement is going to go through because the families of who were involved in these various incidents are weighing in.
Yeah, and don't seem happy.
Right,
yeah,
exactly.
Criticizing it. You know, I looked at this, Julie, I mean, it's another black eye for Boeing. It does mean they avoid a trial, which would have, obviously been a distraction, and, you never know what's going to happen in a trial, so you do put that behind you. But as you know, listen, Boeing faces a fine. There's a corporate monitor. Not something a company ever enjoys. Reports showing the government and Boeing are still, as you know, it's kind of finalizing this. I read reports expect to file the final plea agreement by July 19th. Moving forward now, you do have some dates on the calendar. We've got Q2 results on July 31st. We have Farnborough, the air show, that's coming up soon. And really the big question, which is interesting too, by the way, the stock's up 0.5%, maybe on some clarity. That's what investors are reacting to, who knows? The big question is also, who's leading this company?
Right.
Who's actually going to be CEO? We hear about potential candidates. Maybe it's Pat Shanahan over Spirit Aerosystem. He's certainly being talked about, but still, who is going to be in that C-suite when Calhoun steps aside?
The clouds over the stock are not removed with this settlement, even if we see a little bit of a boost for the stock today. By the way, as part of all of this settlement, $455 million is what Boeing is going to be required to spend on compliance and safety measures in the coming 3 years. So that's part of all of this as well, if it does end up sticking.
Yep. All right, our next trending ticker, Exxon. That company revealing it expects refining profits to drop due to lower margins across the industry, reducing earnings estimates for the second quarter. This will be the oil giant's first earnings report since closing on that $60 billion deal for Pioneer Natural Resources. And so that was the headline here. Julie, we did have some new numbers from Exxon. And I guess what the investors are trying to figure out is what that means for the bottom line. Exxon saying earnings from refining will decline between 1.1 and 1.5 billion in the second quarter compared with the previous 3 months. And I did see some analysts, I think it was RBC, quoted as saying this means when they did the math, earnings per share overall maybe look light versus consensus.
Yeah, and also we should mention that the company is dealing with Hurricane Beryl and the effects of that right now. Houston, a lot of that city is out of power. It's affecting Gulf operations as well. So that's just something on the side that it's dealing with as it's also come out with this update. Full results from the oil giant are going to be coming on August 2nd, so we'll get more color around Pioneer. Some analysts said the contribution from the Pioneer acquisition were not as good as had been expected. So we should get more fleshed out information when we get that full earnings report that's coming up. All right, let's broaden it out and talk about what's going on the macro level because it is a big week for investors. We'll be getting a fresh reading on inflation this Thursday that could help build the case that the Fed should begin to cut interest rates in September. For more on the week ahead and what it means for the economy, we want to welcome in Veronica Clark, economist at Citi. Veronica, it's good to see you. And what I find really interesting about the Citi call on what's going to happen with interest rates is it's a good reminder it's not just about when they start. It's about what happens after that and how frequently they keep cutting rates. And you guys think we're going to have a streak here once they start going. Talk us through that.
Yeah, exactly. We have the Fed cutting rates for the first time in September, which is not so much out of consensus anymore. We're pricing about 20 basis points or so for September. But yeah, where we're more out of consensus is what happens after that. We do think the Fed is cutting every meeting after that. So that includes November, December, and into the first half of next year. And that consecutive cut call is increasingly premised on this idea that the labor market is softening. We had very strong 200K plus payrolls on Friday, but that unemployment rate ticking up, I think, will be increasingly concerning for Fed officials. We're now at 4.1% on the unemployment rate. That's above the Fed's year-end forecast. So I think that will really, what gets us to those consecutive cuts.
And Veronica, when you're talking to clients and they ask you, what are the risks to this call? What do you tell them, Veronica?
Yeah, I mean, we are still, I think, in a, we're kind of on this trade-off. Are we going to have a soft landing? Are we going to weaken further? I think we have a much easier time now than maybe a couple months ago of convincing people that things are slowing down. A couple months ago, the story was reacceleration and growth picking up again. Maybe the Fed would have to hike again. That looks much less likely. But I think for us, it really just comes down to the normal macro dynamics. Most recessions, most downturns do start very gradually. They start very slowly, and then at some point you encounter this nonlinearity. You get the bigger increase in layoffs. We have seen this rise in initial jobless claims lately. It kind of feels like we're on the brink of that now. Maybe the biggest pushback is the overall numbers still look pretty good. It's just the extrapolating that trend does not look so good.
Veronica, what are the other warning signs that you're seeing in the data?
Yeah, I mean, I think it really does, mostly come down to the labor market. We've seen, for a number of months now, 9 months or so, hiring really pulling back, hours worked that are coming down. It looked to us like all of those early steps that employers would be trying to, cut labor costs. They're not laying anyone off yet, but that would really be the last step. But as that, dynamic has happened and it's been getting harder and harder to find work, if you do happen to get laid off, we have seen this pullback in spending. We've had retail sales, moving sideways to slightly lower for a number of months now. And that pullback in spending, that's less business revenue. Maybe that's what gets you to that final step of layoffs. So it is really just this gradual deterioration that we see.
Veronica, I'm curious too, our central bankers are on Capitol Hill this week. Jay Powell with his semi-annual testimony. I'm curious, Veronica, you'll be listening. What do you think Jay Powell has to say?
Yeah, I think the risks tomorrow, we'll hear from him first tomorrow and then on Wednesday, are that he sounds relatively dovish. It's interesting that we're hearing from Powell first, among Fed officials after that unemployment rate number on Friday. But he did sound like a central banker who's getting more worried on the labor market, employment side of the Fed's mandate. We've heard that from some of the other Fed doves also. I don't think he's going to, really flag, alarm bells just yet. But I think he'll be increasingly worried with that unemployment rate rising.
At the same time, it feels like inflation is going in the Fed's direction, right? Are you pretty confident that we're going to see a benign reading in CPI on Thursday?
Yeah. I mean, as confident as a forecaster can be, maybe. There's always things that can happen. You never know. But yeah, we're expecting another pretty favorable reading for the Fed, a 0.2% month on month for core CPI. That's a very normal reading. Even in the details of that, I think we might see, finally some slowing in shelter inflation. That's been a very sticky, strong component of inflation. That might look more normal on Thursday's data. So that would be, the Fed getting more confidence that inflation is easing.
Veronica, great to have you on the show today. Thanks so much for joining us.
Thank you.
And coming up, it's the latest edition of our series, Goodbye or Goodbye. We're breaking down 2 stocks to help you make the best moves for your portfolio. Stay tuned, more market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're hitting on the low and high notes of music companies. I'm here with Barbara Duran, BD8 Capital Partners CEO and CIO. Thanks for being here. So let's talk about some music companies. One of my favorite topics, actually, is to talk about music, so I'm happy to do so. Universal Music Group is the stock that you would be looking at a potential buy. The stock's done pretty well over the past year. Trades in Europe, it's up about 33% or so over the past year. So let's talk about why you like it. Streaming growing and pricing for streaming is getting better for the artists that this company manages.
Yeah, it's been a big sea change in the last 18 months or so, really driven by names like Spotify, a stock that's up 100%. And it takes, and just a little bit of history about the music business, you know, when I guess in the first 15 years of 2001 to 14, the sales dropped dramatically, and that's because digital media, came into being, and people did not want to buy the physical records. So it went from 23 billion to 14 billion. Then streaming started to catch on, and so it's now back up to 27 billion. So you've had a very big sea change, and the sea change is paying. It's become much more what they're calling artist-centric. That you are now paying every time I download a song, I am paying that artist, and that is through the big music, studios. And that is the big three are Universal, Sony, and Warner. And so it's a very interesting time because they're really seeing their revenues come up with a decent amount of their revenues from the streaming services.
And it's also interesting because Universal had an agreement with TikTok, lost the agreement with TikTok, but the last earnings report actually looked pretty decent. As you say, this is one of the big three, and it's actually the biggest of the big three, I believe.
Yes.
With its market share.
Right, it is. They've got about almost 30% of share. Sony is number two with about 19%, and you have Warner bringing up somewhere between 14 and 15%. And in this business, that's a big difference because usually when they're talking market share, they're talking about the catalog, right? The catalog is the millions and millions of songs that they have, and it's an advantage to have that kind of scale. Because an interesting thing that's happening with streaming is all these sort of the iconic names of the past, are becoming even more popular, and you're seeing more downloads. In fact, there was an interesting stat, the UK market. 8 years ago, 53% of downloads were this iconic golden oldies type of thing. Now it's up to 77%.
Wow.
So yeah, and the thinking is that it's probably not only the older generation figuring out how to stream, but it's also younger generation who never heard these songs, and a lot of it's great music. So you're seeing the streaming and you're seeing something like Spotify, who's being very aggressive in building their business, and they're seeing something like 19-20% more active monthly users every month. That's big. They've got about almost 750 million listeners, about 250 million that are subscribers, and that money flows directly to all of them.
Yeah, and as you say, also, it's not just how many artists they have, it's who they have, right? And we actually have a graphic, I believe, of some of the Universal Music Group art. I mean, Taylor Swift won with a bullet there, right? Like that's the one. That's obviously she's been dominant. But they also have legacy artists like Sting, Bad Bunny, Sabrina Carpenter, who's been hot this summer, Kendrick Lamar. Warner, on the other hand, which we're going to talk about in a minute, it has some big artists, but in terms of the depth and breadth.
Well, that's it. Because what happens when you have all the big names, it makes it much easier to recruit new names, right? When you're Warner and you're sort of in third place, you've got to offer more. You usually can't give as good royalty deals, to this place. You don't have as much capital. And so when you've got the scale and you've got the global infrastructure, offices everywhere, it really makes a difference. And you're seeing that. Universal's gaining share in just about every category.
Well, as you know, we have to talk about what are potential risks here. And I guess the potential risk here is that a subscription service like a Spotify will be able to continue that momentum.
Exactly, because the thinking right now, when analysts are really doing their projections, there's only about 15% penetration in smartphones worldwide in terms of streaming music. So the thought is that will grow. So you've got not only the growing subscriber base, but the players like Universal, who have deep benches both in the iconic sort of music, but also these big stars. Because apparently 2% of the stars is what's played for 95% of the time.
Right.
So it's huge.
That makes sense.
Yeah, it does.
So we already teased it, but let's talk about the company that you think is not as good a buy, and that is Warner Music Group. The shares are up over the past year, about 9%, so they've really lagged. So let's talk about it. Smaller, first of all. You talked about scale important. They don't have the same quantity
No,
of
they
scale.
don't. And I'll tell you where that starts with, not only in your recruiting and finding the top artists, because you'll say, oh my God, Taylor Swift, I want to have the people who have the ability to promote me and get me out there. So that hurts. Plus, it's also technology and AI. You've got to spend a lot. There's lots of things going on. They won't have those kinds of resources. And also when they negotiate their royalties with artists, it's usually they have to give more, to say, well, look, don't go with this player. We'll give you better pricing.
And also there's as you said before, talent sort of begets talent. And I guess the opposite can be true.
Yeah, that's really it. And I think that's why you see for the disparity in the stock performance between Universal and them, because Universal has much higher growth. They have a great management team and they know how to do it. And this, it's been erratic, in their execution. And I think it's really a function of their size and scale.
And I think the third one we kind of already alluded to, the pricing pressure, that is that they have to,
it's pricing pressure,
more
right?
To attract
Not
artists.
only right on that, but it's also, in terms of streaming and all that sort of thing. So we will see, what happens there.
Now, what could go right for Warner? The streaming business numbers could continue perhaps to improve.
Yeah, and also what's interesting is that gaining share in terms of their deep, music base, from the past. And so, you mentioned Sting. Names like that, it's like the riches that keep giving. It's also higher margin business because it's already sunk costs. They've already paid for those artists way back when to get them where they are. So the more it goes to the deeper in their catalog, the more higher margin business and the more visibility. Because you can have years of visibility knowing what you have in your catalog.
What we call the legacy artists, sadly.
Yes.
Okay, so you are telling folks buy Universal, avoid Warner Music. You don't hold either of these in your portfolio?
No, I don't hold them, and I wouldn't say. I want to make clear, Warner is not a short. Because a rising tide. They will be helped by all these, industry. Forces that are happening. But again, as you mentioned, they have really underperformed. This stock has been up 3 times what Warner was in the last year, and year to date, Warner is down. And I think this deserves a premium valuation. It will maintain that. And the only reason I think people would buy Warner because they think, okay, it's down and dirty, it's discounted,
right.
But I think it will always be discounted to Universal.
All right, Barbara, thanks a lot. Really appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
All right, let's check in on a few of the top analyst calls from today. NVIDIA shares higher on the back of 2 price target boosts. UBS raising its outlook from 120 to 150, citing demand momentum for the Blackwell chips, while Wolfe Research also raising its price target to 150, calling it one of the best ideas in semis. So UBS, for its part, talks, Julie, about demand momentum for Blackwell rack scale systems, says it's robust. Sentiment, yes, they say it's recently faded on the stock in the last few weeks, creating what they say is more a wall of worry that should be ultimately healthy if our outlook materializes. And then separately, as we know, Wolfe also raised their target to 150, talk about ASPs and improving mix driven by Blackwell.
Now, I'm sort of blown away. I don't know why I'm continually surprised by estimates for NVIDIA, but I still have the capacity to be surprised, apparently. So the consensus calendar 2025 earnings per share estimate for NVIDIA is $3.69, according to Bloomberg estimates. UBS says, no, it could be closer to $5 per share because of these channel checks that they're doing. Wolfe puts the number around $4, but $3.69 versus $5, that's a pretty big gap here. And the naysayers with NVIDIA have talked about this slowing growth trajectory all around. There's no way they could keep up this pace of growth. UBS says, well, given what we're seeing when we talk to people who are buying this stuff, there is still high demand. Now, we'll see if that does end up being the case. But it's still, it's
incredible.
Has its capacity to say, wow, $5 versus $3.69.
Well, isn't our friend Corey Johnson, if you tour him, didn't we ask him? And he said in his career, never seen anything like it.
No.
Never seen anything like NVIDIA.
We've thrown around the word unprecedented a lot after the past few years, but it still applies in some cases. Let's get to another mover now. Melius Research suggesting the second half of the year could see some major gains for the likes of Intel, AMD, and Apple in what analyst Ben Reitzes calls the catch-up trade for stocks that underperform in the first half. And he's looking for a model at last year where he said we saw a similar phenomenon where these stocks didn't do well in the first half and then they caught up in the second half of the year. And those are just some of the names that he's talking about. He's talking about the product cycle for Apple being helpful. He's talking about semiconductors like AMD and Intel coming back as well.
Yeah, and to tie back to NVIDIA, his note to his clients, what he says is NVIDIA's Blackwell actually isn't the only product cycle to pay attention to in the second half. Would you believe it or not? Yes. So to your point, Julie, I like this note, sort of time to dust off the AI laggards again was the title of the note. And he talks about Apple and the iPhone 16 and how street estimates are low for the iPhone franchise. And then he also talked about some other things too that were interesting about the AI-ready PCs, a big theme. Listen, we've talked to a lot of smart analysts about that. Some questions about how that will play out, but he talks about how that benefits some names like Intel and AMD. And then also mentions IBM, by the way. Big Blue gets the shout out. Underperformed in the first half, he notes. Now he says he sees revenue upside from Red Hat, and they also talk about help from some recent acquisitions over there as well.
Yeah, it doesn't hurt that the Taiwan semi is also rallying today, so we're seeing a big chip rally. Overall, I think TSM above $1 trillion in market cap today in its U.S. valuation.
Finally, shares of ServiceNow. Now, they are sliding today. Look at that, down on about 5%. On the back of a downgrade from Guggenheim to sell from neutral, citing second half concerns in the company's Gen AI monetization. So, all right, Guggenheim cuts to sell, target 640. Not many sells on this name, by the way. Only actually just 2 on the street. Doesn't mean he's wrong, by the way. The company seems to be expecting an uptick in Gen AI business in the second half, Julie, but our fieldwork indicates this is not likely until 2025, if ever.
That was the part I bolded from the note as well.
That was the dramatic caveat, yes.
Yeah, so, I mean, and this is, it's interesting. I wrote about this for the Yahoo Finance Morning Brief recently, that there is all of this expectation around Gen AI, but particularly with these software companies, they're not necessarily seeing it flow to the bottom line or even the top line as of yet. The other thing he said that stuck out to me, he said, we believe there's a material risk that now we'll have to lower top line subscription guidance for 2024. Now, he says there's a real sales culture at ServiceNow that has powered its numbers, and that might sort of, if not mask any weakness, it might help them get a little bit more of a runway. But, with that sell rating, he doesn't seem that confident.
He pointed for his clients. He said, listen, there's some risk to my call. If there was significant increase in federal spend, he said, that could result in upside compared to what I'm looking for. Higher revenue contribution from Gen AI solutions than maybe he says I'm modeling or anticipating. But as you point out, Julie, not his base case. They report on July 24th. So maybe another update then, and we'll see what happens. All right, moving on. Office vacancies hitting an all-time high record in the second quarter at 20.1%. It is the first time the sector has ever eclipsed 20%. It's according to a new Moody's report. And with us now is the co-author of that report, Tom LaSalvia, head of CRE Economics at Moody's. Tom, it is good to see you. So looking at this Q2 preliminary trend report, Tom, you do say, listen, the office sector, record vacancy rate, 20.1%. Where does that rate go from here, Tom, in the next, let's say, 6-12 months? And what factors, what variables does that depend on?
Yeah, unfortunately for office property owners, that vacancy rate continues to go up. Some of our most recent research shows that with remote work really here to stay, we could see a 22 to 24% vacancy rate as at the peak of distress. That's likely to hit sometime in 2025, maybe even early 2026. So there's still a couple of years of accelerated distress as this plays out. One of the key variables here, it's going to be, office employment, of course. And we know that the labor market is beginning to soften. And another key variable here is remote work. And remote work, as I said before, it is here to stay, at least at some level, right? I think there's still a trial and error period that's going to last multiple years. But we know that square footage per employee is going to continue to drop.
And Tom, when you talk about a peak vacancy rate in office of 22 to 23%, I mean, so people know, you said in the second quarter it was about 20%, so still an increase from there. what then is the long-term vacancy rate, right? Like, in other words, how long can it stay at 22 or 23%? Is that the new normal?
It's a great question. The way we're thinking about this as obsolescence, that there is a good 10 to 20% of office buildings out there that really just will not be able to compete in this new era of remote work, this era of new offices, this era of new, let's say, centers of power in terms of where office-centric locations are, right? I mean, you're getting migration into the Sun Belt. You're seeing even within metropolitan areas like New York, certain submarkets doing much better than others. And so what you're left with is 10 to 20% of obsolete offices that are going to have to find some new life in this new era, right? They're going to have to go the way of a lot of these Class B and Class C malls over the past 30 years.
And do you see that? I mean, that was one big trend, Tom, that was often talked about, that you would see office buildings, repurposed as, for example, residential buildings. I mean, is that, when you do your research, Tom, is that actually happening? Because it seemed like there would be such tremendous red tape and bureaucracy to make that happen. Or no, is that a trend we're seeing that's actually playing out?
No, well, a combination of both of those things. It is a trend that we're seeing, right? And we've seen it. I think the financial district in New York since 9/11 is a perfect example of how you can take at least older office buildings with smaller floor plates, and you can renovate those into valuable residential real estate. So there is a precedent for that. I think the problem comes in is when you have some of these 1970s, 1980s office buildings where there's not a lot of natural light hitting the center of those buildings. That's where you're going to run into real cost pressures that make it prohibitive to actually go ahead with one of these renovations. And so where does that leave us? That leaves us with a lot of subsidization, a lot of public-private partnerships in order to convert some of these obsolete office buildings from that era.
Tom, finally, I wanted to ask you about a report in the Wall Street Journal today that talked about potential fraud that has elevated the valuations of some of these office properties, that now that the market's pulling back, maybe those are being uncovered. Now, I'm just curious how much of an issue you think that is in the market, and then how that affects what we're going to see next.
Well, what I can say about this is there's been a lot of extensions, there's been a lot of modification, a lot of work with loans, a lot of non-transaction activity going out there, whether it's from the loan perspective or from the sales perspective. And that has not allowed really any price discovery. So whether there's fraud or not, or cooking of books or whatever it might be, a lot of that's going to have to come out over the next year or two, because again, especially if that building is considered obsolete in this new world, right? Where do we go from there? There's going to have to be some liquidation of that asset, and the truth has to come out about really what are the occupancy levels, the rent levels, what's the income, what are the management expenses, right? What's going on with each and every of these properties? So price discovery is going to be a really big deal because of the distress we see coming over the next year, 2 years. I think we do see a lot more of that price discovery, and we see a lot more of the specifics of some of these properties.
Tom LaSalvia, quite a picture here of the office market. Thanks so much. Appreciate it.
Thank you.
Coming up, shares of SolarEdge have had a rough first half of the year, but one analyst sees opportunity in the pullback. We'll speak to her after the break.
Tesla shares fighting for gains, trying to extend its win streak to 9 straight sessions. Stock now at break even for the year. Inez Frey is here with a look at what is driving the stock higher. Inez.
Hey, Josh. Yeah, it's a nail biter because Tesla right now is up about 0.6%. It opened lower, then went up about 2% earlier today. So let's see what happens. But look, over the last 8 sessions, Tesla shares are up 37%. Over the last month, about 40%. Remember, this stock hit a 52-week low on April 22nd when it hit around $138 per share. Right now, it's at $253. So it has been a huge run over the last month. Of course, the production and delivery beat. The stock topped last week because of that, but also you saw the stock going higher even before that. There's some positive Wall Street calls or analysis after those production and delivery beats. Even though delivery was down year over year, it still beat what the analysts had been expecting. Dan Ives over at Wedbush has a $300 price target on the stock. Adam Jonas and Morgan Stanley called out that this is more than a car company in his note. And he pointed out what some other analysts have also been pointing to, which was the show stealer, what was Jonas called it. And that is its energy segment, which is the fastest growing segment for Tesla. Energy storage. This includes products like Megapacks. These are massive rechargeable batteries that are used for commercial and industrial use. And what's interesting about this segment, yes, it is a much smaller slice of the pie when you look at Tesla's overall business, but it is the fastest growing, and its profit margin is also large. It's at a record just above 24%. You compare that to Tesla's automotive, which is around 18%. So you can see why analysts are excited about this segment, even though it is a smaller piece of the pie. But just taking a look at where we're at with the stock, it's break even for the year. It's come off those April lows. It's a massive run for the stock over the last month.
Ines, thanks a lot. So we'll see the photo finish and where it turns out today, where it ends up. Thank you. Well, shares of Solar Edge have had a rough first half of the year, down roughly 70%. Bank of America Securities now sees opportunity in the pullback, upgrading the stock to neutral, citing an appealing valuation as the stock is already priced in an unlikely worst-case scenario. Joining us now, Dimple Gosai, clean energy analyst at Bank of America Securities. And Dimple, so it's not that you're positive on the stock. You are at a neutral. But you're less negative on the stock here. And given that 70% pullback, what kind of scenario is the stock pricing in here?
Good question, Julie, and thanks for having me on. So for those that aren't familiar, Solar Edge is a power electronics company. They do DC inverters, they sell optimizers and battery storage systems too. So you're right, the stock is down 70%, underperforming its closest peer Enphase by close to 50%, and the broader solar index by close to 50% as well year to date. I think, the stock is oversold. Investors are largely concerned that we might see the likes of inventory write-downs. You are seeing Solar Edge struggling with things like customer accounts receivable extensions, monetizing the balance sheet, weaker underlying demand. And the question is really, when can these underlying trends really reverse? And so that's the fear in the market. We arguing that the stock here is largely overdone.
Dimple, so you move to the sidelines. What do you have to see to make a buy rating on this one?
Yeah, good question. So one is I'd really like to see the balance sheet. I'd like to see underlying demand firstly improve, because that would mean that, this inventory congestion that we are seeing today, largely prevalent in Europe, were to unwind. And similarly, weaker end demand in US were to then turn, which would really change what we see from the balance sheet. That's the first thing. Secondly, I'd like to see, Solar Edge execute on some of these IRA tax credits, expand US manufacturing, kind of see margin growth here, and with that, the increase in cash flows. So not yet bullish, but looking for signs of incremental growth. And so that's really where we're looking for signs in the second half of this year.
Dimple, I wanted to sort of zoom out a little bit and ask you about the solar industry more broadly, because it's been a lousy year for a lot of these companies. SolarEdge is not alone. I was looking at the TAN ETF, the Invesco Solar ETF, which is down more than 20% year to date. At a time when solar adoption has been increasing, as you said, there are tax credits in the U.S. at least, and in other places that are available. What has gone wrong, and what would turn the cycle?
Good question. And I think one is interest rates, the cost of financing, one. The second thing is just weaker consumer demand, especially in the residential solar segment. And then three, tax credits is something that we are seeing companies really take advantage of, utility scale and resi, but we won't likely see the benefits of this until next year, when you can really, include them or get the cash upfront. So that is something that we yet to see the benefits of. So those are probably the three main things that are hindering the sector, I would say. And then there's also the, regulatory policy. So for example, in California, which is, north of 60% of the residential market today, we're seeing policies like the net energy metering policy, or NEM3, which is similar to the Netherlands market, which is really decreasing or has hampered the growth or end demand growth amongst consumers.
Dimple, thank you so much for joining us today. Great chat.
Thank you for having me.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it's market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session. I'll start with where the major averages ended up today or down. In the case of the Dow, it was the only one of the three majors to end in the red today, down about 0.1%, about 31 points. As we've been talking about, investors waiting for a lot of big events later this week, and in the meantime, not a lot of action today, but it was enough to push the S&P 500 to a new record. It indeed closed in the green. 35th record that we have seen, record close that we have seen for the S&P 500 this year. The Nasdaq also managing a record close despite a lot of volatility in a pretty tight range today, but a lot up and down. But ending the day higher by about 0.25% for the Nasdaq here. Jared, what's caught your eye in today's session as we have seen these little but incrementally record gains?
Yes, little but incremental. I was noting the difference, as you noted, between the Dow and the Nasdaq. Dow slightly negative today, but interestingly, the Russell 2000 is more positive than any of the three majors, and that's kind of an outlier in and of itself. What do I make of it? Not too much, but just something to put down, see if it happens a few days in a row, then we can have a conversation. 10-year T-note yield just about break even there on the day, not a lot of movement in the bond market. What we're seeing is outperformance in tech by a pretty wide margin here. And it's interesting that communication services, another mega cap sector, is actually the least positive. And we can see this when we drill down into the Nasdaq 100. Here you have NVIDIA. It's been down recently, a few days, but it is up again. I think it's the highest level in about 10 or 11 sessions. Apple, this might be a record high. We've seen record highs from Apple recently, but we're also seeing some, and yes it is, but we're also seeing some weakness. Microsoft down, Amazon, Alphabet, Meta really the outlier, down 2%. That's obviously not a disaster. So when we take a look inside tech, this is where it gets interesting. You can see all these semiconductor stocks. Some of them are even dark green. AMD up 4%, Intel up 6%. Contrast that with what we're seeing in software, where we're seeing mostly red. Yahoo Finance's Josh Lipton and I are going to talk about that in 30 minutes. And here he is now. Josh.
Thank you, Jared. For more on the markets, we're joined now by Adam Turnquist, LPL, Financial Chief Technical Strategist. Adam, it's always good to have you on the show. Maybe, Adam, let's start off big picture. You look at the S&P 500. What are the charts telling you here, Adam, at least in the kind of near to intermediate term?
Thanks, Josh, and appreciate being on. Look, when you step back and look at the market, it's hard to argue with record highs almost on a repeated basis here. But when we view it from a technical lens, we're very overbought. We're getting very close to retesting the upper end of this rising price channel that's been in place, really going back to the lows of October 2022. And we're also getting divergences in market breadth. Last week on Friday, we only had 4% of S&P 500 stocks make new 52-week highs. That number steadily declined. You compare that to the rally to the March highs. When it was advancing, you had broad participation. Really not the case. We're seeing a long list of divergences at the breadth level and even at the economic level. When you look at some of the ISM services data last week, manufacturing, both dipping into contractionary territory. So what does it all mean on a shorter term basis? We think we're probably due for a little bit of a pullback here.
What does it mean on a longer term basis, though, Adam? I mean, because we've seen some shorter term pullbacks. Breadth hasn't been good for a long time. So can that continue sort of indefinitely?
Longer term, we think the strategy here is to buy the dip. We don't think you need to chase this rally right now, just given how overbought the market is. Look at where leadership is, especially in the semiconductor space. Very overbought. Having a good day today, but even if you look at the Nasdaq Composite, it's a 20% premium to its 200-day moving average. That's over a 2 standard deviation move. Historically, when you look at that, compare it to weak breadth, you typically get a pullback, and that's really the playbook as we look ahead to the second half.
And Adam, we talk a lot about this narrow leadership. Do you see signs in the charts of any kind of, real rotation?
Not yet. We've thought of this market as really kind of a field of dreams bull market. If you build it, they will come, meaning the mega caps lead, some of the smaller caps and other sectors follow, but we're really not seeing that take place right now. And I think that speaks to some of the weaker economic data that we're seeing. A lot of the economic surprise indexes now moving into negative territory. That wasn't the case last year when we had most of the economy surprised to the upside, given the recession call that started 2023.
We've also been watching, and this is a chart that we flagged earlier, that stocks are making these records at the same time that profit estimates are moving up. And so what tends to happen? Well, you know, I guess profit expectations are also at record highs, according to this chart from Bloomberg. But what tends to happen when you see that kind of movement?
We think the bar has been raised for earnings as we look ahead and kick earnings off on Friday with some of the big banks looking at quarterly earnings growth of around 8 to 9% on estimates. Think back, we've come out of an earnings recession over the last year. So earnings momentum is definitely there, but it's all about reality and expectations. And I think the expectations are now a little bit higher than they were, give it a couple quarters ago, for the S&P 500 at least.
Adam, I know you can't talk specific names, but I am interested, if you pop up in the hood of the SPX, are there sectors, technically speaking, that you think look more attractive, Adam?
Right now, we like communication services. We think it provides a good barbell in terms of mega cap exposure, but you also get some of the more defensive qualities and the legacy telecom names. That looks attractive. Industrials is another theme that we like when you think about infrastructure spending. Also has a bit of an AI play with data center, not only the build outs, but storage. And then energy is a more defensive play. It's relatively cheap compared to the broader market. Great free cash flows in that sector and a likely spot for a rotation if we see some money come out of tech.
In turning to sticking with those technicals though, Adam, looking at the sectors, which ones would you avoid here, at least near to intermediate term?
Yeah, right now we think healthcare is going to be a laggard. That was a recent downgrade from our house view. It's a consistent underperformer, even though it does have some defensive qualities. Right now, we're just not seeing it on the technicals. Continues to put new lows in versus the S&P 500, so that would be an area we'd avoid.
Adam, thanks so much. Good to see you.
Thanks for having me.
Let's talk about another stock that we are watching today. It was AMC, finishing Monday's trading session firmly in the green, up by about 8% following another strong weekend at the box office. Solid sales of new merch also helping. That's according to CEO Adam Aron. And Yahoo Finance's Alexander Canal joins us now with the details. Despicable Me 4.
Yeah, are your kids fans of Despicable Me, Julie?
They're fine with it. Right. They're aging up a little bit. What about you, Josh?
No.
No?
Not yet.
Despicable.
Not anti. I just think it's over her head still.
Well, maybe she'll be a fan of Despicable 5, 6, or 7 because
gosh.
there probably will be those coming, considering how well this film is already doing. So far, so good. It debuted over the long 4th of July holiday. It's grossed about $230 million worldwide, which did include $122 million over the domestic holiday weekend as well. But that's not all. According to that tweet from CEO Adam Aron, the film lured in 4 million guests and was the most attended Wednesday through Sunday of 2024. The merch also was really important, with sales of that merch the second biggest ever for AMC, and that's behind the Taylor Swift Eras Tour movie. Remember that movie that debuted last year? Apparently, a lot of people want to get those Despicable Me Minions.
Is that what they're buying? I was going to ask what the merch was.
Is the Minions? I guess they think they're really cute. They want to buy that. And considering the Taylor Swift movie, they probably sold a lot of T-shirts, things like that fans were doing. So this is a success. Also, food and beverage was really strong as well. And that's something that you sometimes forget about when we talk about a lot of these theater chains. That's not just about the ticket sales. It's also everything else that comes along with it. Of course, when we talk about AMC, it's one of those stocks that normally has some volatile swings. It's one of the OG meme darlings, not always tied to fundamentals, but box office performance is fundamental to this company. And when you think about the box office overall, especially as we kicked off the summer season, it was a bit of a rocky start, but we seem to be finding our footing with the box office, not just Despicable Me, but also Inside Out 2 performing really well. So a lot of those animated, family-friendly movies seem to be outperforming this summer. We'll see how that carries through to the rest of the year.
You know, it's funny. I'm looking at Cinemark. Those shares were up just 0.5% today.
Yeah.
Maybe you know what the difference is? Your CEO doesn't tweet.
Yes, I was just about to say that. I mean, you have the CEO basically touting how successful this was. You have to think, oh, that must be a really great weekend for a company like AMC. And normally when we have strong box office results overall, we'll see a trickle throughout all of the big box office chains. AMC is the largest, especially in the United States. But again, we're not totally out of the woods yet when you think about the box office at large. We probably will never be back to where we were pre-pandemic. So it's just a new business, and because of that, you kind of have to have a new business model too. And I think the food and beverage, the merch, that's a big thing as well.
And tweeting to people who like meme stocks.
Exactly.
That legitimately, that's part of the business model at this point for him.
Kitty Army approved
doesn't
that
hurt.
message.
All right,
Yes.
thanks, Sally. Appreciate it. Coming up, the U.S. has a big-time debt problem, but who is footing the bill? More market domination over time coming up.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Americans have a $35 trillion question on their hands. Who is going to pay for our nation's ballooning national debt? Joining us now is Yahoo Finance's Rick Newman. You know, Rick, I always assumed it was me, frankly, and my kid, but who else?
Well, it is going to be you and your kid and me and all of us, really. Neither of the candidates this year, Joe Biden, if he remains a candidate on the Democratic side, and Donald Trump on the Republican side, is really leveling with voters about this. No politician really does. And the reason is pretty obvious. There's nothing for anybody to like in how we solve the problem, and there's a lot for everybody to hate. Now, there's a new analysis out by a budget expert at the Manhattan Institute named Bruce Rydell. He does some good work on this issue. And he has come up with a way to address the problem of the national debt. And that doesn't mean paying the whole thing down. That's kind of impossible. but it means just stabilizing the debt at about 100% of GDP, which is around where it is now. In other words, preventing it from growing much more in the future. And here's some of the ways he says things we're going to have to do in order to do that. There are going to have to be benefit cuts in Social Security and Medicare for wealthier participants in those programs. He would make no changes for people who are in the 40%, the lowest 40% of households in terms of earnings there, but some serious changes for wealthier seniors. And let's keep in mind, a lot of seniors don't have a mortgage anymore. They own their home outright, or they have a very small mortgage payment. They don't have child care burdens. And there are a lot of people who have millions of dollars in savings, and yet they generally qualify for all the Medicare and Social Security benefits that are on schedule. That's just going to have to change. I think that's simple math. Brian Riddell does also include some increases in individual income taxes for the wealthiest Americans. There are some modest changes in business taxes that would take away some tax breaks and some other changes. There's nothing draconian in this plan, such as, for example, a value-added tax or what's basically like a federal income tax, which would raise a lot of revenue all at once. And I think that's the point of this plan, which is that if you just do a certain number of things and do them fairly soon, including things that a lot of people are not going to like, you might actually be able to address this problem without having to overhaul the entire tax system or have massive tax cuts or tax hikes, or something that would cause a recession. So this problem is solvable. There are many other analyses that show the same thing. It's solvable. We just need politicians who are willing to tackle it.
What will be the catalyst that will tip them in the direction of doing that? I mean, what would constitute a crisis that would force action?
Well, I think it is going to take a crisis. I mean, there have been warnings about this for the last 20 years, maybe 30 years, and Congress has done nothing except make borrow even more money and make the debt even higher. So the crisis, if it happens, if it gets to that point, in other words, if Congress and the next president, the one after that, just don't do anything, what the debt crisis is going to look like this. The U.S. Treasury is going to be issuing so much debt that there aren't going to be enough investors out in the world willing to buy it. We've seen a few wobbles in the market for Treasury securities within the last 12 months, nothing like what I just described, but the Treasury has begun to alter the way it sells securities, changing the duration of the notes and bills that it's selling, for example, and do some things to make sure those auctions go smoothly. If the Treasury gets to the point that there just aren't enough people to buy all of that debt, and the market for debt is not bottomless in the world, we might be getting close to the limit. Then the only thing that can happen then is interest rates go up, and they might go up by a lot. And if you try to do stuff like Federal Reserve money printing or other types of money printing, then you get inflation. So if you really screw this up, you could get soaring interest rates and runaway inflation. And that would certainly make everybody more disgusted than ever with all the politicians. And that might be what it takes. I mean, if you were running a business, you probably wouldn't want to do that, but that is the way we run the country.
And Rick, just switching gears here a bit, President Biden seems to be kind of doubling down here, Rick, pushing back on these calls we've been seeing to drop out of this race. What are you thinking, Rick? I just wanted to get an update on where you are right now in this.
I mean, the battle is clearly on within the Democratic Party. And I think it's fair to say that the odds of Biden dropping out, I don't think there's any reason to think he would resign as president. But there is obviously a chance that he would withdraw as the 2024 presidential candidate. I mean, those odds have clearly been going up. But all of this tension might actually be pushing us to a new and a better place that we needed to get to anyway, which is that Biden is now under intense pressure to get out in public more and prove. He has to prove that he is not the feeble old guy that we saw in the debate on June 27th. So he supposedly is going to do another press conference this week. I think that demands for this type of thing will just intensify. He has done very, very few press conferences or live interviews where he's really been on the spot, and he's had to be able to show that he can muster thoughts quickly and parry any kind of accusations leveled against him, and that he's sharp enough to fight this kind of fight he needs to fight against Trump. Trump, as we learned from the June 27 debate, one thing Trump can do is he can still attack. He's still very agile on the attack. So Biden needs to be agile on the defense and on the counterattack. And, I think this would be a good development if we just see Biden coming out much more than he has before, not reading off the teleprompter as much, talking to ordinary people, ad hominem exchanges with people. And let's really test this guy and see if he's up to it.
We shall see. Rick, thank you.
Hi, guys.
Let's get back to markets here and talk about emerging markets in particular because they're catching the eye of investors. Global X, for one, noting a significant pickup in interest in emerging markets as it steps out from the shadow of developed markets. Malcolm Dorson, Global X Senior Portfolio Manager, joining us now to discuss. So, Malcolm, start with what you're hearing from clients on emerging markets here and why you think there's been a pickup in interest.
Sure, Julie. Thanks for having me. Well, I think a few reasons. First of all, investors have been dramatically underweight emerging markets for the past decade, and it's really worked. We've seen a lot of success based off of U.S. exceptionalism. But now emerging markets are getting to the point where valuations are just too compelling to ignore. We're now also seeing a little bit of momentum, being the second or third best performing asset class in the world year to date. And in addition to that, people are looking for different opportunities, whether it be alpha generation, portfolio diversification, or just plain old U.S. dollar hedge, given the concentration of performance that we've seen in the U.S. thus far this year.
So, Malcolm, let's dig into some of these opportunities. You kind of divide them, Malcolm, into different buckets here. So in your structural opportunity bucket, for example, you like India. Make the case there, Malcolm. Why India? And also, by the way, do you think it's sort of fair the way that people compare India to China, or no, do you think they're just too different economically and demographically?
Yeah, no problem. Thanks, Josh. You can compare it, but end of the day, it's an easy comparison because I think it's a better opportunity. Unlike most opportunities in emerging markets right now, this is something that you buy for your grandchildren. I mean, India is growing 6 to 7% GDP for the next 5 years, with EPS at 15 to 20%. And importantly, Indian companies have the opportunity to reinvest this growth and these earnings into compounding opportunities, really profitable return profiles between 16 and 18%. And then kind of bringing it back to that comparison versus China, India now has a larger population than China, a younger population than China. It's benefiting from this, multinationals are looking for global supply chain diversification outside of China. And in addition to that, this is all being run by a democratically elected government, which I think brings a lot of assurance in terms of governance to investors.
To just zero in on China for a moment, does the China risk change under a Trump versus Biden presidency?
I don't think so at this point. I mean, it's really difficult, big picture, to make predictions on China right now. I think it has been for the past 4 years. But in terms of what's happening from a U.S. domestic perspective, it seems like both candidates are kind of competing on who can be more hawkish and who can be tougher on China. So from that perspective, I think a lot of investors are looking for either single country opportunities, just investing in India or just investing in a country like Brazil, or emerging markets ex-China strategies. And then in terms of China, where they're finding opportunity are areas that are less reliant on the rest of the world, less reliant on the West, and where they find an alignment of interest with the Chinese Communist Party. And that's mainly Chinese consumption.
And just, Malcolm, just drilling down on Brazil for a bit there, because I know that's another opportunity you see. How come, Malcolm? And I'm also interested how how has that economy sort of developed and evolved, Malcolm, over, say, the last 5 or 10 years?
Sure. It's a great question. It's been moving with politics, and it's been a political pendulum. We've seen some great things in terms of reforms, tax reform, fiscal reforms, state-owned enterprise reforms to the central bank, and a lot of positive steps and from a big picture perspective. But at the end of the day, Brazil is still a very cyclical story. And at this point, I mean, it's been a roller coaster. Brazil was up over 20% in the fourth quarter. We're down almost 20% in the first half of this year. So it's created another window of opportunity for people to step in. But right now, I think this could be the best trade over the next 6 to 12 months. I mean, this is based off of very discounted valuations, a very advanced monetary policy cycle. The central bank's already cut interest rates 325 basis points, and really significant exposure to a robust commodity base. But let me just take a quick pause there. You guys had Rick on a little earlier before this segment, and he was talking about the risks of ballooning U.S. national debt. debt. And big picture, if you have any concern about national debt in the United States or the direction of the US dollar, which has been amazingly strong the past decade plus, Brazil is a fantastic hedge against that. And historically speaking, for every 1% weaker US dollar move, Brazilian equities have popped 5%. So I think from that perspective, it's really interesting as well.
Well, and I also wanted to ask you about the traditional relationship between emerging markets and U.S. interest rates, right? At a time when it looks like rates are going to go lower, maybe before the end of the year, right? Is that something that tends to be a catalyst as well for emerging markets?
It does. I think it's a really good point because at the beginning of this year, we were all so enthusiastic and excited about interest rate cuts in the United States and the spillover into international and emerging markets. We were thinking first cuts in March, we're going to get 7 cuts this year, fantastic. And since then, all we've heard is kind of more hawkish rhetoric, kicking the can down the road, higher for longer. But despite all of that, I mean, EM should be having a pretty bad year, but it's the third best performing asset class year to date. And gold prices are up, copper prices are up, oil prices are up, EM assets are up across the board. And that tells me that this rally is based off of more structural factors, supply and demand, CapEx cycles, expansionary PMI across the board. And if/when we do get interest rate cuts, that's just going to add fuel to the fire. So I think that we could be at the very beginning of a really interesting cyclical upswing.
Malcolm, super interesting conversation. Thanks so much for joining the show. Really appreciate it.
Thank you, Josh. Thanks, Julie.
Time now for What to Watch, Tuesday, July 9th. Starting off on the Fed Chair Jerome Powell is on Capitol Hill starting 2 days of congressional testimony. Tomorrow, Powell's going to be speaking in front of the Senate Banking Committee in the morning. This committee is coming after committee member Elizabeth Warren sent a letter to Powell last week criticizing him for having private meetings with top bank executives and accusing Powell of giving them too much influence over Fed policy. Central Bank responding, saying it received the letter and plans to respond.
And we'll be getting some commentary from Fed Vice Chair for Supervision Michael Barr and Fed Governor Michelle Bowman throughout the day as well. Bowman reiterating last week that now is not the right time to cut and saying there needs to be clearer inflation data.
And taking a look at the economy, the latest small business optimism index for June is coming out in the morning. Economists forecasting that number to tick down slightly after 2 straight months of increases in April and May.
And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Biden doubling down, the president pushing back on calls to leave the 2024 race today as lawmakers return to Capitol Hill. A candidate change could spike market uncertainty, of course, but in the near term, investors have a slew of economic data and earnings results at the front of their minds. Plus, Bitcoin fighting to stay above $55,000 in a volatile day of trading. Significant selling pressure continues to mount against the cryptocurrency as the German government offloads its holdings and creditors await the latest moves from the Mt. Gox bankruptcy estate. And a cooling labor market has meant workers are less likely to take risks by voluntarily leaving for new roles, but that does not mean the employees who are staying put are feeling fulfilled. We're taking a closer look at the trends at play in the workplace. Bitcoin continues to sink today, but crypto digital asset products are seeing inflows for the first time actually in weeks. For more on the cryptocurrency landscape, we're now bringing in David Bailey. He is CEO of BTC Inc. and organizer at the Bitcoin conference. David, it is good to see you. So, you think about this year, David, Bitcoin, of course, you had that strong first quarter. Everybody very excited about those new spot Bitcoin ETFs. Now, lately, David, not as much. First and foremost, is it Mt. Gox? Is that the primary issue here, David, that's been causing some selling pressure?
Well, first off, Josh, thank you for having me on the show. And I have to say, investors are still very excited about the Bitcoin ETF. Thank God we have the Bitcoin ETFs because it's been a brutal week of selling from the German government and Mt. Gox bankruptcy claims finally paying out after 10 years. And so those ETFs are actually absorbing a lot of the liquidity blow that's happening right now. So we're about 2/3 of the way through the German government just dumping their Bitcoin. And we're eager to see it concluded. But I think that will wrap up probably next week.
What would you, David, you look at the potential kind of near to intermediate term catalysts, what would you be looking for? Is it, a dovish Fed, a rate cut or two? Would that help?
I think there's probably two major catalysts that are driving the Bitcoin action right now. First off, we just had a Bitcoin halving that occurred in April. Historically, every Bitcoin halving has caused a supply shock with Bitcoin. And so these are kind of the precursors to what makes the price of Bitcoin dramatically rise over, the next 2 years. And so a lot of people in our industry are very eagerly watching that play out. It takes time for the supply shock to really bake into the market dynamics. And then the second kind of new catalyst, I'd say, is the political environment for Bitcoin. Just today, details were released about the RNC's official platform as it relates to Bitcoin and crypto. And for the first time ever, Bitcoin is one of the key components of a major political party's platform. So I think that there's a lot of positive developments to come on the political and geopolitical side that are really kind of brand new catalysts for our industry.
Just let's stick with politics, David, because my understanding is you actually met former President Trump. I'm just curious how that came about, David. What'd you guys talk about?
Yeah, we talked Bitcoin mining. We talked how Bitcoin is aligned with the president's agenda for energy independence, for energy abundance, for America First, to really dominate what's a strategic asset of the United States. So the president is very aligned with the Bitcoin industry and sees the opportunity that Bitcoin offers the United States, and also the risk, a lack of action would bring about as well. So it was a very fruitful conversation. It's also where, the president in his classic style coined the term, we want Bitcoin made in America. So it was very successful.
It's interesting, David, because you have, as you're pointing out rightfully, you're seeing this, crypto has become an issue in this election, and it's interesting to see Trump positioning himself as an ally of the crypto community. Do you think that works, David? Do you think he'll win over the crypto community?
Yeah, absolutely. It's already happening. There are 70 million people that own Bitcoin or crypto in the United States. And there's an old political adage that people vote their pocketbook. Now, digital assets, Bitcoin, is people's pocketbook. And so when they're making an analysis of who they're going to vote for. There's a lot of single issue voters that their number one priority is what's going to be good for the value of my portfolio. And so when you look at the two candidates right now, Trump has done a really amazing job at making himself stand out as really the only candidate to pick. So, we are trying to raise $100 million for the president's reelection effort, and we're trying to turn out 5 million votes, swing votes, in this upcoming election. And so I think, Bitcoin is really having its political moment.
David, I'm also curious, I want to get you out on this. When you talk to friends and family, and maybe they don't own Bitcoin and they're thinking about it, what do you tell them? What's the reason you say buy Bitcoin? Do you say, David, store of value? Do you say medium of exchange? What's the story you tell them?
It's a little bit of all of it. I think, you kind of cater the message of Bitcoin to who the buyer is. There's different things that intrigue people about the technology. Personally, I think what's most exciting is like we live in a world that's very fractured. Our monetary system is very fractured globally. Bitcoin represents a fresh start, the ability to rebuild and re-architect our monetary system for the world on a clean infrastructure. And so when I look at Bitcoin, I make the case of Bitcoin as kind of the primary asset of a future monetary system. And fundamentally, it's the number go up story. It's like, what is one Bitcoin theoretically worth if Bitcoin fulfills its potential as the new monetary system?
David, it was great to have you on the show. Thanks for making time for us.
Yeah, Josh, thank you for having me on.
Yahoo Finance's Jared Blickery joins us now with more on the trading day takeaways. Jared.
Well, since the Mag 7 is the entire market, I'm noticing some rotation in the Mag 7, and that is underway. And let me explain. I'm going to show you first our mega cap heat map here. Not this. I'll pull that up. And what we can see is a rotating cast of characters, not all green, not all red. In fact, Apple today was the only member of this group, at least of the ones on the left, that closed at a record high. You can see NVIDIA here coming back into the fore. But NVIDIA hasn't made a record high in probably about 2 weeks now. Let me just show the year-to-date chart there, and you can see it's been kind of going sideways here. And I'd bring up the fact that last year, NVIDIA was going sideways for most of the year, about half of it. So this is something that happens. But meanwhile, when NVIDIA was kind of taking a back seat, guess who made record highs last week? It was Alphabet, Amazon, Microsoft, I believe Meta was in there too. So you're not seeing that in Tesla, but even Tesla had its run in the sun. So Tesla's pretty far away from a
streak. Yeah.
Tesla's pretty far away from a record high, but here's a 5-year chart, finally getting to some interesting levels here.
Yep. And now let's stick with tech, Jared, because you on this very show have been also talking to us about the drama, the saga, chips versus software. Where are we there?
Well, I'll tell you where we are. Chips today are beating software today, but this is another aspect of the rotation that's going on. It's a healthy part of the market, or a healthy aspect of the market. You can see NVIDIA there. That's a leader, obviously. That's up almost 2%, but AVGO, Broadcom up 2.5%. Just seeing a lot of performance, and then you contrast that from the view that we get when we look at software. Well, that's another story. But I'll tell you what, you look at the year-to-date totals, you're going to see lots of green on the screen, a little bit of red. Very similar situation for the semiconductors, maybe a little bit less red, maybe a little bit more green, but that's what you want to see. And it's this rotation that I'm talking about isn't limited to tech. Now, we haven't seen like financials and industrials really perk up recently, but that's what they did last year when the Mag 7 finally took a backseat. They stepped up. So that's what we want to see. Is it going to happen this time?
All right, Jared Blickery, takeaway point number 2.
You bet. Are we only on number 2 right now? All right, I'll go a little faster. Record earnings expectations. Now, here's a very simple chart. This goes back to kind of December 2021. S&P 500 earnings expectations, they are at a record now, $259 per share. That's the forward 12-month target there. And what's interesting, this bottomed right around the change of the new year at the beginning of last year, but stocks actually bottomed in October. This is forward looking. You can probably shift this forward 3 or 6 months. So what this is telling me is there's still gas in the tank for earnings to run.
And when you look at this, is this all big tech? This is all Mag 7?
It's not necessarily. There's a lot more going on in here. I was just showing some heat maps with the other Mag 7. I do expect some of these stocks, some of these other groups to perk up, but who's to say when that's going to happen? What I am encouraged by is that we're seeing a breadth expansion in earnings expectations, and let me break that down. So if you take all the components of the S&P 500, over 80% of them have experienced earnings revision to the upside over the last 3 months. So that's all gas in the tank for the next 3 months.
All right, Jared Blicker, final takeaway. Let's get to it.
Yes. All right. SOM rule close to being triggered.
Let's do it. Let's
SOM
get
rule, that
nerdy.
is a recession rule. And so I did I'm not going to go over the exact formula, but if unemployment ticks up to 4.2% the next month or the month after, so we're talking about the July readings and the August readings, that could green light the Fed cutting rates in September. And that is ahead of an election year or ahead of an election. But this is such good cover that the Fed could probably get away with that. And I would expect if the rule does trigger, I think people will say, Jay Powell, why are you not cutting already? And some people are already doing that.
Quickly, Jared, astute viewers would ask you, how does the yield curve inversion compare here, which can also signal recession?
Okay, so the SOM rule is immediate. When you see the SOM rule trigger, you are at the beginning of the recession. The yield curve inversion doesn't take place for maybe a year, up to 2 years. And by the way, the yield curve has been inverted 2 years. I think that's a record. So hasn't really fired off the yield curve hasn't fired off the recession the typical way that we're looking for, but the SOM rule could show us that we're in it in a month.
Chips, Mag 7, SOM rule, it's all there. Thank you, buddy. Appreciate it. Coming up, the Great Resignation may be behind us, but what does that mean for companies as more workers voluntarily stay put? More asking for a trend on the other side. First, we saw the Great Resignation. Now workers are staying put. According to the Bureau of Labor Statistics JOLTS report, the number of quits was down 500,000 in May compared to a year ago. The quits rate typically serves as a signal for how willing workers are to test the labor market waters and voluntarily making the leap to a new role. Joining me now is Jessica Kriegel, Chief Scientist of Workplace Culture at Culture Partners. Jessica, it is good to see you. And, on this trend, Jessica, there was this very good, smart article in the Journal, which talked about how increasingly people feel stuck in their jobs. The labor market's cooling, declining turnover, fewer internal moves, people feel stuck. If viewers are watching this, Jessica, and they feel stuck, any advice for them, Jessica? What could they do? What should they do?
Well, the music is stopping, and in the game of musical chairs, you want to have a seat, which is why we're seeing the quit rates slow down, because ultimately we have to be able to pay our rent and pay our mortgage, and the opportunities are not as out there as they used to be. So what does that mean for you, to answer your question? If your listener is feeling stuck, you may be stuck. Acceptance is perhaps the first step in allowing yourself to be okay with being stuck, because sometimes that is the nature of the cycle that we're in, and that's where you are. There's also something that you can do as an employee when it comes to advocating for yourself. If you're not being paid fair wages, you can show your value to your manager and ask for that increase. If the culture on your team doesn't feel very good, you can influence the culture yourself. We're all co-creating culture together. This isn't just a CEO-led thing. So you can take initiative to make that better internally. But the reality is some people are stuck, and we might just have to be okay with that.
Are there all, Jessica, I would also think, are there moves, though, an employer can make? An employer doesn't want people feeling stuck. That just leads to people feeling disengaged. Are there things employers could do? Can they get more creative? Can they, have people move to different cities or, experiment on different teams?
Yeah, I think all of those kind of perks and benefits are things that CEOs are trying right now. But if you want to get to the core of a culture of accountability where people are taking initiative, where they're driving results and they're passionate about it, you have to think about how people are, what they believe in the workplace, right? So many leaders are focusing on what can we do? Maybe we move people, maybe we let them work from home, maybe we give them this benefit. But what is it that they believe about the value that they're creating, their importance in the workplace, whether or not they're on a team that really cares about what you're doing? And the way that you influence beliefs at work is through the experiences that you co-create for each other. So I would dig deeper as a leader if I were trying to motivate my employees and think about the employee experience that they're having every single day and what experiences I can improve to drive the right beliefs so that they really care. Because if I'm a CEO, I want a team of people who deeply care if I want to drive shareholder value.
There may be some employers, Jessica, I'm just spitballing here, who are listening and saying, the economy is slowing. You can see that in all kinds of data now. The labor market is cooling. Frankly, they may say you should just be thankful you have a job. Is that the right attitude, the wrong attitude? How do you think about it?
It's not the attitude that I would want to have as a CEO, but it's not necessarily ineffective, right? At times, that is the problem with these economic cycles, is that we invest in people when we can, and then we divest when we can. And so if you have short-term thinking and you're just trying to get to the end of the quarter, end of the year, then yeah, let people be, let them be. Sometimes leaders actually do this intentionally so that their employees will go. They want to increase attrition, and you're seeing also increased layoffs right now. So, that is because people are trying to weed out all of the people who aren't putting in that extra effort. As an employee, show value, show your worth, and you'll be able to hold on to that job a little bit longer.
Big, important trend and theme. Jessica, thank you for helping us walk through it. Appreciate it.
Thanks for having me.
And coming up, earnings season kicks off later this week, and expectations sky high. We're going to take a look next in our chart of the day. Today, the S&P 500 hit its 35th record close this year. And with earnings season set to kick off later this week, expectations are also near all-time highs. Yahoo Finance's Julie Hyman joins you now with a closer look. Julie.
Yeah, with our chart of the day here, which comes to us courtesy of Bloomberg that looked at some of this data. So, we have seen these record closes one after the other. You earlier talked about it as a very slow sort of melt up. I think Ed Yardeni is the one who talked about that. And indeed, that's what it's felt like here. It's not today, the gain in the S&P 500 was only 0.1%, but those little gains day by day is a steady melt upward that has caused all of these record highs. Now, it has happened at the same time that we have seen profit expectations ratchet up and up and up. In recent quarters, those profit expectations were a little more muted, perhaps easier to beat. That might be a higher bar once we start getting companies reporting in earnest starting this Friday with the big banks. And so this is one of the reasons that some strategists have been pointing to as perhaps a cause for caution. Mike Wilson, who's been a long-time cautious strategist on Wall Street over at Morgan Stanley, had talked about a potential pullback that we might see as a result of this. Adam Turnquist of LPL, who we talked to earlier today, said it's possible in the short term that we would see a pullback. But then we also talked to Barbara Duran of BD8, and she is still pretty optimistic here.
At some point, there's going to be a pullback. We know that. And what we've seen so far year to date, though, it's been shallow. And I think that's what's going to happen here because the underlying fundamentals are positive. The economy is slowing down. People are glad to see that. It means the Fed, is restrictive, and they will admit that, and that's working.
So there you hear Barbara saying even if there is a pullback, it's not going to be a dramatic one. So even though you've got perhaps stocks getting a little, the rally that we have seen getting a little bit long in the tooth, and Josh, there are a lot of reasons for that people have pointed to as well that are underlying reasons why it might not last, including the lack of breadth in the market. But you still have some optimism out there.
And some optimism, Julie. We've been talking to some strategists, and they'll talk earnings. They'll also talk about how, increasingly some investors thinking, we get this weaker than expected economic data. Okay, they think maybe it just means Jay Powell cuts.
As long as it's not too weak. I think that's really the caveat here, is that it has to be in this sort of delicate middle zone, right? I mean, but to your point, folks like John Stolfus over at Oppenheimer raised his forecast for the S&P 500 to 5,900. So we are still getting that phenomenon of the forecast continuing to go higher, even as there are, warning signs that others are flagging, at least in the short term. But for the full year, there's still a lot of optimism out there.
For sure. Thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.